Hi everyone, it's Alex Perini here for the Summerhill live Q&A. We received several questions from our clients and today we'll focus on the most topical. So we'll discuss what is a recession, what is happening in the economy versus what is happening with share markets, and how recessions can impact investment markets. So the first question is, what is a recession? A recession is simply a period of time when the economy is contracting, generally a decline of over two successive quarters. So you will see unemployment rising, people spending less money, and some businesses shut down. Recessions are a normal part of what's called the business cycle and usually are quite short compared to the longer-term expansionary period. So the next question is, if economic news is so negative, why are markets increasing? Many are finding it confusing that when negative economic news emerges from the press, it is accompanied by a positive response or increase in the stock market. It's easy for investors to see economic news like unemployment or GDP data and get worried or excited about the impact the data will have on their investments. It would have been hard to think in March that the stock market would have had the biggest 50-day rally in history in the midst of a pandemic, but there have been plenty of times in the past where the stock market is seemingly out of step with the broader economy. It is important to understand that the stock market is not the economy. Economic data looks backwards, but the market looks forwards. The share market incorporates expectations about the future into share prices today. Economic news, on the other hand, is backward-looking, essentially telling us what has already happened and often telling us way after it's happened. So by the time the economic data is released, the market has typically long been pricing it in. From there, it's essentially a question of whether the data was aligned with market expectations or not. Whether news is good or bad does not necessarily matter. What matters is whether news is better or worse than what the market expected. The market hates uncertainty more than bad news. If things aren't as bad as expected, poor economic news can be greeted with a positive share market reaction. It's only unexpected economic events, which are by their nature are unpredictable, that drive large short-term changes to share prices. A recent example is that 20 million jobs were lost in the US in April. That was the worst month for job losses on record. The US market closed up 1.7% on the day that information was released. The reason for this was because the market was expecting job losses would be around 22 million. The bad news was better than what the market had already priced in, so we saw a market increase. I'm not saying that it can't go the other way. If bad economic news is worse than expected, or good economic news is not as good as expected, the market can drop. But the point is, the relationship between the share market and the economy has little to do with what's happening in the economy and more to do with what's happening in the economy relative to what was expected. There have been plenty of days in history where terrible economic data has been paired with historically high market returns, and this is one of the reasons why market timing is so hard. So, how will recessions impact my investments? The important thing to understand is that with every recession, there is a recovery. Share prices generally fall before economic declines start, and shares then start rebounding while economies are still declining. It's hard to fathom such massive moves we've seen in share markets already this year, and we're only halfway through. But again, once you start digging into the historical numbers, you may be surprised to see that huge up and down movements in markets happening in the same year are not that out of the ordinary. Perhaps surprisingly to most, though, is share prices have actually risen during the vast majority of economic recessions. As an example, Australia has experienced 20 economic recessions in the past 150 years, and share prices rose 17 out of those 20 recessions. Share prices rose during the last 9 recessions. Some of the best years for Australian shares have been when the economy was contracting or still weak, and this is also the case in other major developed markets such as the US. The hard part for investors is having the courage to buy shares when the economy is still contracting and the media headlines are still full of doom and gloom about corporate collapses, bankruptcies, and rising unemployment. So what is needed for a recovery? Australia is now in its first economic recession since 1991. Many recessions don't have a long-run impact on the economy. The worst recessions in terms of long-run impact are generally a product of governments and central banks not acting quickly enough, or their responses just not being effective. And in the case of the COVID-19 recession, the policy response has been extremely impressive. There is widespread acceptance that the government-ordered shutdowns created instant recessions and unemployment around the world. The debate now is about how deep and how long the recession will be. And the truth is, no one knows what will happen from here. A common concern is that the rebound in share markets that we've seen already is too optimistic or irrational. Much of this recovery can be attributed to how effective government support and monetary response has been, which occurred nearly as fast as the bear market itself. But we have also seen falling new coronavirus cases in developed countries, positive news regarding potential treatments, and the reopening of developed countries as lockdown measures have been eased. Continued government and monetary support will be the key to the recovery, along with continued improvement on the health front. But we also need time. We need time for businesses to recover. Everyone has an idea about how this crisis will or should unfold from here. And the worst thing you could do in an investment environment like this is assuming there is only a singular path forward. When going through a bear market and rebound, markets don't recover in a linear fashion. Periods of disappointment are always interspersed with periods of optimism. It should be clear, though, that economic outcomes do not translate directly to share market returns. Share market changes are driven by expectations about the future. In times of volatility, such as what we're currently experiencing, those expectations can change quickly based on new information. But it cannot be known ahead of time how new information will impact share prices. Try not to get too caught up with short-term market fluctuations. The market is no place for short-term investors. Instead, stay focused on factors that you can control. Paying attention to economic data might be interesting for some people, and it might even be useful from the perspective of understanding what's going on in the world. But for investors, economic data should not play a role in forming your investment decisions. If economic data makes it hard to stick to a well-thought-out or long-term investment plan, it might just be best to ignore the information altogether. We remain steadfast in our advice that all long-term investors should continue investing in a diversified portfolio suited to their goals and adding to it as often as possible to average out the entry costs over the market cycle. As with all market shocks, this too will pass. So that's probably enough for me today, but thanks for watching. We hope you found this useful. And of course, if you have any queries or topics that you'd like covered in future live Q&As, we'd love to hear from you. If you enjoyed the video, please share it with anyone you think might benefit. Thanks.